This is the Weekend Tech Report, where we will go over last Friday's market action and we'll discuss what we may expect in the near future. Let's start things off with the equity sector. All the major market indexes got a boost on Friday. This, of course, as a result of speculation that Ben Bernanke left the door open for future monetary easing. He expressed grave concern for a stagnating jobs market and articulated that the Federal Reserve is ready to step in should such actions be necessary. While it was not the immediate action item that many speculators were hoping for, it successfully makes the mid-September meeting of the Fed a tantalizing affair. After all, despite the speculative boost in the indexes, the numbers are only slightly above key thresholds. The equities need a sustained rally from here, or we can see some ugly things happen. Therefore, keep an eye out on the VIX and make sure to consider hedging your bets against volatility by buying VIX futures or ticker symbol VXX. Let's take a quick look at currencies. The US dollar lost all of its gains from Thursday's session, with the Friday session closing at the 81.20 level. Currently in overseas trading, there is some limited market action taking place, giving the index a very small increase. However, our longer-term forecast is proving more accurate than not, and we continue to see signs of weakness in the greenback. As expected, the euro made gains against the dollar, which currently is challenging the 126 level. For the Japanese yen, we may see its index challenge the 77 level, which would signify a stronger yen and more headaches for its export-driven economy. Let's move over to the big discussion point of the day, gold. The yellow metal had a massive move on Friday, gaining $30 to close at the 1690 level. Of significant interest is the volume, which also received a substantial boost from speculation of QE3. Technically, we believe that this is setting up gold for a spectacular rally in the months ahead. One key point to look at is that between its record high last year until July of this year, most of the price action took place between the 20-day moving average and the lower Bollinger Band. However, starting from the beginning of July, we find that the price action is taking place between the 20 DMA and the upper Bollinger Band. We expect this trend to continue, and if so, watch out for higher prices ahead. Moving over to silver, we see much of the same thing, a massive move upward that blew apart the $31 level, and it now sees 32 at its sights. A close at the 31.80 level made that inevitable. One key difference, though, is that silver is overheated according to the 14-day relative strength indicator. This makes me hesitant in forecasting its next move. For example, looking at the 6-month chart, we have 3 significant markers in the RSI to consider. At the first point, the RSI bottomed at 10, which is extremely oversold. As expected, it bounced up from there and then went for another dip at point number 2. However, the second point closed at a higher level than the first point, and then a month later at point number 3, we see that the RSI closed up higher than its recent peak. This suggests that the closing price prior to the third point was in fact the bottom. This means that the rock bottom of the upcoming movement is at $26, but realistically the lowest we may see from here on out is perhaps $28. On the upside, I am looking for $40 by year's end, but you got to watch the current RSI level, which is over 80. We may see a declining flag pattern in the future, which will likely be a bullish pattern and will represent an opportunity to load up before another massive move.
For more unconventional ideas, please visit crushthestreet.com.